Hi guys, welcome back to the channel. My name is Dave, and today we're going to be talking about combining a monthly paying dividend stock with a covered call. It's going to be so relaxing. It's going to make you want to invest. So if that's what you're looking for, please stick around. Whoop. Yes, just look at that happy little white fluffy dog on a sunny day here. Just stress-free investing. That's what we're looking for. No need to hunt all day for the perfect stock. All those option trades, rolling them over, working it all day long. No, just set it and forget it. Get outside, walk, enjoy. Look at those happy little trees. This is Bob Ross style investing that I'm talking about, guys. So I just posted a video about monthly paying dividend stocks and using those within M1 Finance. But, I thought I should continue this series one more time, at least for one more time, and talk about how you can combine monthly paying dividend stocks with an option, so with a call option in this case. So, I kind of like these monthly paying dividend stocks, and I kind of explained that in the other video, and I'll link that above if you want to go watch that one. But the idea here is, you can buy some stock, you can sell a call against it way out, kind of like a leap, maybe not a full year out, but way out there, and get a nice return. So that's what we're gunning for today, Bob Ross style. I have plenty of positions within my portfolio that I just don't mess with. It's the ETFs that I just buy and hold. Pretty much anything that begins with a V, like VOO or VTI or VYM. I got them all somewhere tucked away. And over the last few years, they've been great. They've been growing rapidly. They've been doing a great job. So I'm always looking for different avenues to stuff some money into. And I love the idea of just kind of set it and forget it. I've talked about that before. Just buy simple ETFs and you can have success investing. But I started looking around a little bit, and I like some REITs now because inflation is on the rise. And, I think some are poised to do quite well going forward. So I've been shopping around a little bit, looking at different ideas. And I talked about a few of those in that other video that I mentioned. And today I want to talk about one of them in particular, and this is LTC. So we're going to look at this stock and talk about it, and we're going to explain some definitions here. And hopefully I can kind of convince you. Again, I'm not your financial advisor, right? We covered all this before, but I want you to tell me what you think about this trade. The setup is quite simple, just like any other covered call. We're going to accumulate 100 shares, and then we're going to turn around and sell that call. But we're going to do this kind of like a leap. We're going to do it out a couple hundred days as far as they offer this out there. And we're going to see what kind of return we can get when we combine the return of the option with the dividend pay rate of this particular REIT. So we combine that, we're going to see, does this make sense? Should we make this investment? And of course, this could be done with any number of different monthly paying dividend stocks or REITs. I just happen to like LTC at its current position. So it's come off its highs, and it's a REIT that invests in senior housing and healthcare properties. So we do have an aging population. I see this as a 1, 2, 3-year play where I might have to add to this position as it moves along. As COVID, as people recover from COVID, could they have some issues with people not being able to pay rent? So these are the reasons that the dividend could be cut. So we're going to put just a little bit in at a time, sell a call, maybe add to it later, sell another call. But I think over the long term, it'll give us a nice return, right? So let's take a look at the chart. Let's talk about this REIT, and let's see if this investment, purchasing these shares plus selling the covered call, makes this a good, worthy investment for us. All right, so as I mentioned, LTC Properties. They are a REIT that invests in senior housing and healthcare properties. So I like REITs. I've been investing more and more into REITs this year with inflation, and in this particular case, with senior housing and an aging population. I think there's a lot of potential with LTC Properties. Now, if I look at this 2-year chart, what I see is I've added a 50-day moving average. I've added support and resistance bands as well. So if you go out 2 years and you discount the COVID drop here, and you see it rolling along, we are at the bottom of this support level here. So I think it's a pretty good entry point. We're at about 33.88 right now, and I think my average price is around 33.5. So don't mind the chart. I like the chart enough. If we go and we look at information on this, a lot of people get drawn to the PE ratio, but with REITs, we don't want to use PE ratio. We want to go over and take a look for something called FFO. So that stands for funds from operation, and simply put, when you're talking about REITs, we want to add back depreciation so we can get an accurate picture of how this company is performing. So when we combine this FFO with the price, we get PFFO, and this is going to be our kind of replacement for PE ratio. It's just a better indicator than PE ratio. So I usually look for this value to be under 20. 14.5 is pretty solid. So quite reasonable for this particular REIT. Something else I'd like to look at is the dividend payout. I mean, we're looking at 6.87%, but we're also looking at that and saying, wow, 99.5% payout ratio. Now, with REITs, you're going to have a high payout ratio. They have to pay out a certain amount. But 99.5 now we're pressing pretty high. So if you look at that and you look at the dividend history, in this case, you can see for a long time they were paying out 19 cents a month. But we're getting very close to them not being able to support that, right? So could there be a dividend cut is the question. And I think we're okay. It's just a matter of, can they collect all the rent they need to collect as our economy recovers? So there could be a dividend cut. It's something you should be prepared for. I wouldn't see it being too substantial, but we could see that in the next few quarters potentially. If you make it through the next few quarters, I think we're in the clear. So with all that said, let's evaluate the return on this trade and the covered call and the potential scenarios that could occur and see if this is a good option. So like I said, I think this is a great place for me to park some money right now, get a nice return, and continue to add to it as necessary based on what I've shown you so far. So this is my trade. I'm buying the shares. I'm selling the covered call out about 200 days. And it makes it kind of a leap, right? So a leap is a long-term equity anticipation security, and I've done a video on these. I'll link it above. But essentially, it's a call option or put option, however you want to look at it, that's out about a year or more. Now, in this case, I'm only going out 200 days. So it's leap-like, leap-ish, if you will. So with that defined, let's take a look at exactly what I did. And I purchased these shares at about $33.45 average buy price. And this pays a $2.28 annual dividend, or about 6.8%. I sold these contracts with an expiration of 5/20 and 22 at a $35 call price. And that got me $128 per contract. Now, there's not a lot of volume on these, so I will say it's really important that you don't do market. You set a limit, and you try to get that limit as high as you possibly can. But I got $128 per contract, and it's out about 200 days till expiration when I executed this. So that gives me a 6.4% annualized return just on the covered call portion if I was to average that out over the course of the year. So between the dividend and the covered call, it's 13.2% annual return between those two, premium and dividend. So feeling pretty good about that. Now, let's look at the results. What could potentially happen, right? So this is where I think a little pre-planning really helps. So think about the position you'd be in if the stock goes up, sideways, or down. So those are our three ways, right? So stock up, fine. I get my 13.2%. I walk away with that. Plus, I get $155 more for selling the stock at a strike price of 35, where I bought it at 33.45. So I get an extra $155 for that. If that all happens, then fine. I get 21.6% annualized return. Feel pretty good for something where I'm kind of setting it and forgetting it, right? I'm not putting a whole lot of effort into this trade. Now, if it trades flat, that's fine too. I'm happy. If it doesn't move at all, just goes sideways. Because that means I'm going to collect 13.2%, and I'm going to continue to repeat this process. Okay, so now the big one. The big one is, well, what if it goes down? What do you do? Well, I like this position. I like where I'm at. I like the dividend. And as long as if they don't cut the dividend, if the thesis, or if it doesn't change my feeling on this stock, something between now and then I'm going to feel pretty good. So I'm going to add to that position unless there's significant change, right? Unless something significant changes, I feel good about where I am. That's why you look at the entry point at the beginning, right? And I should add, as this thing gets closer to that 5/20/22 date of the contract expiring, I'm going to look to roll it out probably a month ahead of time. Roll out if anywhere between 31 and 37 prior to that last ex-dividend date that's probably going to be approaching around that time, I'm going to roll it out. So if it's above my initial strike of 35, I'm going to sell it. I'm going to roll it out again. I'm going to see what I can get. And even if it's dropped down to about 31, same thing. Now, if it goes below that, that's probably where I will add to it. So Those are the results. Two final really important points. Dollar cost averaging. This thing pays a dividend every single month. Every single month you can buy a little bit more of the stock, or you can take that money, you can invest it into something else, however you'd like to use it. But dollar cost averaging is the key, one of the big keys, in my opinion, to success in the stock market. Continuously buying, buy. And the other part of this is the time value of money. Something we haven't really talked about a lot yet on this channel, but when it comes to being a seller of options, you get that premium right now, right up front. So in this case, we're getting $128 or so per contract. Well, if you do 10 contracts, that's $1,280. And by the way, I did this selling out of the money, right? Because I think the stock has some upside potential. But if you really want to stuff your pockets right now, sell at the money or sell in the money. And, I did a video too. I'll link that above. So you can go reference back to that. You can sell in the money call options and do quite well with this strategy in this stock, I bet. You have to be really careful about the negotiated limit price that you set for that particular option premium. But you can get a lot of money up front, and $1 in your pocket today is worth more than $1 in your pocket tomorrow. That's the time value of money, and that's really critical to understand that if you can trade a lot of options, put a lot of money in your pocket right now, and then take that money and put it right back to work for you, you're going to do quite well. So I feel pretty good about this trade. Up, down, or sideways, I feel like I'm covered in every direction with what my plan would be. And I would suggest if you get into this kind of thing that you do have a game plan in mind. Now, I think this type of trade, who is this for? Anyone that wants monthly dividends and some upfront money, well, this might be a good option. So check it out, see what you think. There's plenty of other opportunity out there. It doesn't have to be LTC Industries or properties either. It could be something else that you like, that you found that you think will play well with your goals. All right, so there you go. Bob Ross style. Leaps or leapish combined with a monthly paying dividend stock. Set it and forget it a little bit is the idea here. So I can buy this, I can set it up, sell the call, know that I'm getting a decent return. If it starts to drop, I can add to the position, check back in a couple months, see how it's doing, roll it out again. I think in the long run, this is going to be a good trade for me. What do you think? If you think, no, you're way off base on this one, Dave, then comment down below. We can have a discussion about it, and we'll go from there. So I really appreciate you watching. Please like and subscribe. If you have any questions, again, comment down below. We'll see you real soon. Thank you. Bye-bye. Whoop.